This one strategy took me from guessing trades to consistent income every single week. We're going to be talking about credit spreads and spreads in general. So I'm going to explain credit spreads in the simplest way I possibly can. If you look online, you're going to see so much garbage that you do not need when you are trying to trade spreads or learn about them. The whole point of credit spreads is to win on the premium burn and that theta burn. For example, if you get a credit spread with a premium of 0.20, okay, between the spreads, then your goal is for that premium to basically theta out, burn to zero to make full profit. Whereas in a normal trade, if you enter a option at 0.20, you obviously want it to go to 0.40. That'll be 100%, 0.60, 200%. In this case, you actually want that premium to go to zero. So it's a total different way of thinking about it, but it's a strategy that is definitely overlooked in the trading industry, especially for newer traders, especially for traders, again, under that 10-year mark who just are following that options goal that they see on social platforms where people are making 500%, 1,000% on trades. That does not happen every day, and you have to understand that going into trading. If you don't understand it, you will definitely learn it as you trade. So, an example of a spread. We're going to do a SPY put credit spread for an example here. And a put credit spread is actually a bullish spread. So you want the price to stay above a certain level, and that's why you're going to be selling puts. So in this case, we're going to use the example of SPY selling the 382 puts, and then you're going to buy a 381 put. That's how you get that credit spread. Now, you sell 382 put, you want SPY to stay above 382 by that expiration to make full profit by 100%. Obviously, you could exit that trade earlier just like you could any other trade. Now, when you're selling that 382 put and buying that 381 put, you have a $1 strike difference between the 382 and the 381. That is going to be a $100 collateral. So what this means is the entry to open that specific contract is going to be $100. If you want to buy 5 of those contracts, you want to sell 5 of those spreads technically, you would need $500 to do so. Now, in a put credit spread case, you're always going to be selling the higher strike and buying the lower strike. This means you do not expect SPY to go under 382 by that expiration for you to make a full profit. Now, let's kind of do it the other way. And let's say we are bearish on the market. We're bearish on SPY. And we want to sell a SPY 385 call and buy a 386 call. So now, again, that same $100 per contract, except you want SPY to stay under 385. It's always going to be the sold strike where you want the price to stay under or over to make profit on. So now that we kind of understood that, let's talk about the difference in that strike price. We talked about that $1 strike difference with the 385 and the 386, as well as the 382 and the 381. So if we're going to sell let's say we sell another covered call. Okay, so we are expecting SPY to stay under a certain price. We sell a 385 call, and then we're going to buy a 387 call. Now you have a $2 difference in between those strikes, which is going to come out to a $200 collateral difference, meaning you now need $200 per contract to enter that position. Okay, so if you get 5 contracts now, you will need $1,000 to do so. Another thing to reiterate here and to touch up on. So when we are selling the 385 call and buying the 387 call, let's say the sold 385 call is a 15-cent premium when you go to click on that option contract, and the 387 call is a 5-cent premium. So you're going to take the difference between the 15 cents and the 5 cents. Obviously 15 minus 5 is 10 for all you math wizards out there. So your premium per contract that you buy is going to be 10 cents or $10 per contract. So in that case, if we are doing a spread on selling 385 calls and buying the 387 calls, you'll need $200 per contract, and you'll be making $10 per contract on that. So a 5% make on your money. a 5% return on your money. Now, some rules that I like to reiterate when I'm trading spreads is personally, I've realized over my 6 to 7 years of trading spreads, I usually don't like to take a spread trade until around 10:30 a.m. Eastern, which is an hour after the market opens. It kind of just gives the market some time to obviously digest the overnight move, see where we're going, see if there's any news coming out that day. Usually we have Fed data, or sorry, not Fed data. We usually have news data in the morning, let's say CPI or PPI, anything of that sort to get that out of the way at the 8:30, the 9:45, the 10 a.m. mark. I trade specifically same day expiration spreads. I usually do this on SPY, Qs, IWM, or NDX. I have been highly trading the NDX recently. It has just been absolutely phenomenal being able to get certain levels out of where I want to actually take the trade and be able to execute at a very high probability rate. Now, what spreads are, which I didn't reiterate in the beginning of the video here, it's a very high probability strategy if you do it in a smart way. And of course, the profits are going to be lower. But this is a very consistent strategy that could truly change your trading trajectory. So when I'm looking for spreads, I'm usually looking for around 88% probability on the contracts. You could see this when you're going on the sell side, depending on the broker, Thinkorswim, Robinhood, E-Trade, going on and on and on. You could check any broker. It will show you the probability of profit. I usually look for 88% plus probability of profit. I'm also looking at my confluence on my charts. Are we trending in the upside? Are we trending in the downside? And I'm looking to see what the market is going to do that day to take the side of the trade that I'm looking for. There's a key rule that I think a lot of people need to look into. When I talk about spreads and when I've taught spreads and the amount of people that have totally changed over to only spreads trading, the one thing that stuck with them was giving them the example of what they are looking for in their trading day. Now, what I mean by that is if you want to make $100 a day, or if you want to make $500 a day, if that is your goal, you have to have a risk involved with that. You need to know you could risk 2 times that. So the reason why I say 2 times that is because when I have been trading spreads for this 6 to 7 years, I've kind of developed that a 200% stop loss on my profit that is expected has been the key point in making me a successful spreads trader. So if I want to make $100 per day, I am perfectly okay with losing $200 that day on that trade specifically, because you can make that trade back within 2 to 3 trades, and then you just continue that compounding effect on the spreads. Now, spreads, again, you're looking for trades that are 88 to 90%. With consistent profitability on trading spreads, there is always a key factor. With trading spreads at a high probability, around that 88% mark, it's okay if you lose 2 out of 10 trades, 1 out of 10 trades, because that compound effect still grows trade after trade. There will always be losses in trading no matter what strategy you use, and if anyone is telling you otherwise, run far away. So now we're going to go over an NDX trade that I did today. It was an NDX call spread. Okay, the market was gapping up around 1.6% here at the open. Okay, so when the market is up or down 1% plus, I am looking to actually sell that side that it is actually in favor of. For example, if it is up 1.6% as it was today, I'm looking to sell a call spread, because when you look at data, when you look at history, the chances of the market closing over 2% on a day is under 3%. The chances of the market closing over 2.5 or 3% on the day is already under 1%. So I'm already looking in that direction, and this has been a absolutely outstanding strategy that has worked exceptionally during my spreads trading career. So I sold a 760 call on NDX, a 25,760 call on NDX, and bought a 25,780 call on NDX. So my difference there is $20. So that is going to be a $2,000 entry, barrier to entry there. And my profit on that trade was a $1.50 per contract. So again, just under that 7 to 8% mark on the return on that trade with the capital allotted. And I bought 20 contracts at 150 and was able to close it at 0.25 for a $2,500 gain and a 6.3% trade on that specific spread. Now, if you look at my results here, we had an absolute phenomenal year so far. We traded this 5,000 account all the way up to 77,000 currently. And we are having one of our best months in November, and it is only November 10th. We are looking to hit over that 13,905 mark that we hit in August and break our new record for this spread challenge. If you're interested in trading spreads with us, check us out at bulltradefinder.net